So, welcome to the Bitcoin mining module in the CX Academy course. Now, this is probably one of the most important modules on this course, and we're going to dive into exactly how Bitcoin operates and functions in terms of mining and with its blockchain. Okay, so just a pre-warning, this module is going to take a while. We're going to take our time with it though. We're going to try and explain things as best and as thoroughly as possible, while sticking to the fundamental side of things and not getting too advanced. So we're just going to take our time. The contents, there's 24 different lessons here. So if you want to pause the screen and read through, by all means do so. However, I'm not going to read them through. We're just going to start with lesson number 1. Okay, so minted currency. Essentially, central banks print minted cash. We know this, okay? And miners are rewarded with minted bitcoins. Essentially, the miners are the bankers, okay? They are the central banks of crypto. So in terms of banks verifying transactions, banks process payments and update their central ledger, which creates some fundamental issues. Okay, we've touched on these in previous modules. The issues are power and control, human error, corruption, and limited transparency. Okay, we don't have access to the bank's ledger. We just trust that as a third party, okay, that they are doing their job properly. And that's just too much power and control for human error, okay, and corruption. So we essentially are trying to avoid this from happening. We're trying to get more transparent with these financial ledgers. Now, in terms of the Bitcoin blockchain, okay, you can see on the little picture there, SHA-256 or SHA-256. That is a hash function which is used within Bitcoin. So the blockchain verifying transactions, hash functions are used to secure and locate transactions on the Bitcoin blockchain ledger. So we use hash functions not only to link the blocks of transactions in the chain securely, okay, but we also use it to locate transactions, so we can actually view a specific transaction using this hash function. Okay, in particular, it's called the Merkle tree or Merkle root, but they use hash functions. Okay, so this is the transparency layer of blockchain which we're talking about. So the target hash value, in terms of blockchain verifying transactions, the target hash value, or THV, is the hash difficulty of a block. Okay, so briefly, a difficulty is set by the algorithm depending on the amount of computational power connected to the Bitcoin blockchain network. Okay, so this is that mathematical problem, in air quotes, that the miners are trying to solve. Okay, so we'll get into more detail about that mathematical problem, air quotes, in a later slide. So they verify transactions by hashing the block's contents. Okay, and linking these blocks, making sure that transactions are secure within the blockchain. And then the proof of work. This is the work, the computational power that the miners are doing to try and solve these mathematical problems. Okay, so that's how they verify the transactions. It's all encryption based. So then, the miners, they are the Bitcoin bankers. Now, they're only temporary Bitcoin bankers, only when they have the, let's call it the publishing rights to publish a block of transactions onto the blockchain, onto the Bitcoin blockchain. Okay, so let's read through the slide. When miners solve these complex mathematical problems on the network, they produce new Bitcoin. They're essentially miners. They're printing this, not printing, sorry, they are introducing new Bitcoin to the circulation as a reward from the network. Bitcoin miners also make the Bitcoin payment network trustworthy and secure by verifying transaction information. Okay, these are the people who are verifying the transactions by consensus. Okay, so they all work together to agree that the block has been published with the correct proof of work attached to it, which would imply that that block is the correct block in the chain. Okay, as long as it fits in with the previous block's hash, we can assume that that block is true. So then, why proof of work is so important? Okay, this is the computational power that the miners are outputting to secure the network, to uphold the network. So, decentralized consensus mechanism, that is essentially what the miners are doing. It's used to quantify a level of energy expensed by a node miner to find the correct solution to the hash function target value. Now, when we talk about this mathematical problem, what we're actually talking about is a hash function. Now, the block algorithm has produced a target value, okay, so the block difficulty, that the miners must try and find a hash value which meets or is below this target hash value. Okay, now this is the hash function of the block. It's used to control the rate of blocks added to the blockchain. So again, this target hash value, this block difficulty, okay, can be increased or decreased depending on how much computational power is in the network, because we want to keep an average of 10 minutes per block. So we're controlling the rate in which these blocks are added to the blockchain. Okay, that's very important in terms of the halving event as well, and in terms of the minted Bitcoin introduced to the circulation. Okay, the year 2140, the last Bitcoins will be mined. That is a mathematical certainty based on the fact that we can, or the blockchain, the Bitcoin blockchain network can actually adjust its difficulty level to ensure this 10-minute average block time. Okay, again, used to control the supply of Bitcoin into the circulation, and it's used to encrypt the sequential order of blocks, the transactions onto the chain using ongoing hash functions. Okay, it's one big hash value, the blockchain, and we'll get into that in terms of the Merkle root and Merkle tree and how that works later. So then, what is a hash? Well, as you can see on the screen, in the blue, we have an example of a hash value. Now, what's really important to visualize and understand are these zeros at the front of the hash. Okay, now these zeros, this is the difficulty level. As the zeros increase, the hash gets harder to solve. Okay, the miners are trying to find values in which to put through a hash function that gets the output which has the same or less number of zeros. Okay, so that is what is deciding the difficulty level for the miners. Okay, and in turn deciding the amount of average time it takes to find one of these solutions. Now, it's important to note these are average times, and a block might be added after 10 minutes, the next one might be added after 5 minutes. Okay, the next one after that might take 15 minutes. It's an average of 10 minutes per block. Okay, so that's not a dead-on science, it's just an average. Okay, eventually they will average out to be 10 minutes. So then, the hash code is created using a hash function and is a one-way deterministic encryption. Okay, so this is getting a little bit more advanced, but bear with me. So the input value cannot be found by decrypting the hash value. So no matter what we do using this hash on screen and using the SHA-256 hash function, we will never know the input values of this hash. Okay, because one slight change will alter the entire thing. Okay, it's not as easy as putting in the value of 150 and then putting in the value of, if you put in, say, 149, the entire thing will change. It's not like one letter will change because it's one digit that has changed on the inputs. Okay, so we cannot decrypt this. It's simply a hash function. It's a one-way deterministic encryption. It's not designed to be decrypted. Okay. So then, let's explain what SHA-256 is. It's a secure hash algorithm, 256 bits encryption. Okay, so the cryptographic hash function that takes an input data source and turns it into a fixed length alphanumerical string to attach each block to the blockchain. Okay, alphanumerical, it's numbers and letters. Okay, and it's fixed length as well. So each block has a unique public hash key created from the specific contents of the block, and each block contains the hash of the previous to maintain the secure database blockchain. So then what is actually being encrypted? So SHA-256 is not encrypting the data within the block, as that would imply the data would need to be decrypted, like we just said. Okay, it's one-way deterministic. It's simply designed to link all of the transactions on the blockchain together. Okay, in a big Merkle tree hash function. Output, rather. It provides an irreversible method of linking blocks together with a hash that is dependent on the content of the block itself, and linking that hash subsequently with the next block. Okay, using this method, changing the data within a block, any block, would require each subsequent block's proof of work to be done again. So in terms of the proof of work, because we've changed a value of a block, let's say there's 10 blocks, we changed the value in block 8, we would then have to change the values of block 9 and block 10, okay, to throw in more complexity. At the same time, block 11 is being worked on and added to the chain at the same time. So all subsequent blocks change, which means for them to be assigned to the blockchain, it requires another consensus mechanism to allow that to happen, which means people must agree on the new proof of work, which means you have to redo the proof of work for that block and block 9 and block 10. Okay? This makes it incredibly difficult to do. Incredibly. Okay? Because for a start, people aren't going to go backwards on the blockchain and start redoing the proof of work. It's just never going to happen. Okay, the miners on the network are upholding the essentially allowing the network to progress. They want to work on the new blocks of the chain to secure the previous data in the blockchain. Okay, so that is how the encryption works. It strings all blocks on the chain together, and it does it using the computational power of the miners, which is called the proof of work, and the network decides how complex that proof of work process needs to be with its target hash value. Okay, the miners aren't solving a mathematical problem necessarily. They're simply trying to find an output which is the same or less than the target hash value for that particular block. So then, how is the data actually hashed within a block? So we have the block data hash, okay? That is the hash of all the transactions within the block. So we have a block data hash. That is then rehashed with the nonce, the number produced once, which is the potential solution. So these miners are essentially running hundreds of thousands of numbers, single numbers, and I mean single numbers as in they could be any value, okay, but this is a number used once, which is a potential solution. They're throwing these into a hash function, okay, and they're trying to find this THV, this target hash value. So essentially they're adding the block data hash, rehashing it with a random number, and trying to produce the hash value, okay, which is the new blocks hash. Hopefully we're following on here. This is very, very complex stuff. Please don't worry if you are losing this a little bit. Hopefully it will come together eventually, okay? So the target hash value, THV, it's calculated by the Bitcoin's protocol code. And as we've previously said, this changes depending on the necessary difficulty level required to maintain a constant pace of blockchain mining and new Bitcoin supply. Okay, taking into consideration the halving events and the 210,000 blocks or 4-year time constraint. Okay, so a THV is added to each block's new header by the system. Okay, so the network itself will decide the block's THV. Okay, so no one in particular is deciding this. It's all done by the algorithm. So then where is this THV stored on the blockchain? Well, again, like we've just said, it goes in the header of the block. Okay, so we can see it goes in the header of block number 2, for example. So you've got the current block hash, CH2, and you've got the previous block's hash, PH1. Okay, now these will be hashed together to form that particular block's hash value. Okay, now it's not the block number, don't get that confused. The block number is simply number 2 or 3 or 4 or 5. Okay, so to find that particular block number 2's hash, we have to hash the current block's hash, which is the hash of the current transactions, with the hash of the previous block, okay, and a number used once to create that block's hash value. So then, the mining difficulty level. The target hash value can be increased or decreased. Again, it's this mining difficulty level to control the pace that blocks are mined onto the network. So it can be increased or decreased in difficulty depending on the computational power connected to the network. Okay, this controls the rate that blocks are added to the blockchain. And again, we've been over this, it controls the supply rate of new Bitcoins to the system. So the protocol was designed to simulate the rate of mining gold. And again, this ties into the price action of Bitcoin. It's a deflationary asset. Okay, it's supposed to get more and more finite as it is mined. Okay, as well as tying into the adoption phases of Bitcoin, it allows around 120 more years of Bitcoin adoption. Okay, instead of just introducing 21 million coins today, it's going to take time. And time is the best way to get people on board with Bitcoin, okay, as the price slowly increases. Again, tying that in with a hedge against inflation. So Satoshi really did think about what he was doing here. So this also helps combat inflation and increase adoption periods. Okay, allows for the Bitcoin to gradually supply to be stretched over a long period of time, like I've just said. And this mining difficulty is adjusted every 2 weeks. Okay, that's important to know as well. So then, the number used once, or the nonce number. So this is the number added to the hashed or encrypted block in the blockchain when rehashed meets the difficulty level restrictions. Okay, the number used once is the number that miners are solving for. Now then, the Merkle tree. So how is information and transactions stored within the blockchain? Merkle trees serve to encode blockchain data more efficiently and securely. So as we can see, we have the essentially appropriately called leaves, branches, and the roots. Okay, so the leaves, along the bottom we have transaction represented by T. Okay, then we have the hashed value of those transactions, so TA becomes HA, paired with another transaction, for example TB to HB. When hashed again, they become HAB, and as the Merkle tree grows, we can see this hierarchical almost hash value system increase. Okay, so we get the root value of that block. Okay, so each block will have its own root value, and this is the essentially how you're going to find specific transactions within each block. So then the Merkle root itself, this is the hash value of a block's transactions, all of them. It's stored in the header of the block. Okay, so the root is combined with other information, such as the software version, the previous block's hash, timestamps, difficulty target, and the number used once, and then run through a hash function to produce the block's unique hash. Okay? So hopefully this is starting to make sense. There are multiple layers of hashing involved in the Bitcoin blockchain in each block. Okay, now these link together very, very securely. Okay, as you can see, there is a ton of information being hashed together to produce that one-way deterministic value. So if you wanted to view a specific transaction, you would simply break down the root value. Okay, so if we wanted to find HD, we would find first HABCD. Then we would split it up into HAB or HCD. We would go with HCD. Then we would find HD, and we would find the transaction of D. Okay, just briefly, that's how it would work. So then a quick sequence of events loosely. The system produces a target hash value. Miners use computational power to find an input that creates an output less than or equal to the target hash value. A miner finds a solution and is rewarded with bitcoins by the network, and let's call it block publishing rights. Okay, so the block and its hash solution are published to the network for the consensus model to take hold. Nodes validate the block, and when consensus is met, the block is added to the blockchain and the transactions are set in stone. Digital stone. Okay, that's a brief kind of sequence of events there. So broadcasting a block for consensus. When a miner published a block to the chain, consensus must be met by 51% of the nodes on the network for the block to be accepted. We've been over this. We know this kind of, we know how this operates already. Okay. Now, in terms of counterfeiting Bitcoins, you might think, well, the miner has an incredible amount of power when they are adding transactions to the blockchain. Well, in actual fact, they don't have much power at all. It's because of transactional verification, consensus, proof of work, and the encryption of SHA-256, they're all mechanisms that allow each Bitcoin transaction registered on the blockchain to be unique and unrepeatable. It's an immutable ledger, remember, to the point that Bitcoin counterfeiting is impossible. In theory, it's possible. However, in reality, I don't think I think it's impossible. Okay. So, the guessing game of mining. Now, in terms of mining itself, you're essentially trying to solve an equation that the entire Bitcoin network is trying to solve as well. Every miner wants to find the solution because every miner wants to get paid. Okay, the financial reward is a huge driver. Okay. So each THV takes 10 minutes to solve on average. And due to statistical probability, all miners receive minted Bitcoin eventually. At some point, they will get the answer correct and they will be able to publish a block to the chain and in reward get some Bitcoin. Now, as time goes on, the halving event happens and this reward gets less and less. However, the price of Bitcoin due to the halving event, which we're going to explain in one of the coming slides, actually increases because the demand is becoming more. Okay, the Bitcoins are becoming more scarce. Okay, they're not being mined as quickly, and so the price increases somewhat. So, in terms of, before we move on, computational power, it's essentially a game of who has more computational power. So the more guesses you make per second, the higher your success rate, the more profitable you may become. So then, freshly minted Bitcoin, something we've been over a couple times now. Miners are paid per block added to the blockchain. They're also paid in transaction fees, okay? So when you're trading Bitcoin, for example, the exchange might take a fee and the blockchain miner may request a fee, okay? Now, usually when you're buying Bitcoin off an exchange, the fee is paid to the exchange. And usually when you're transferring currency over from one wallet to another, the fee is paid to a miner. Okay, now miners can actually prioritize transactions with higher transaction fees. So if you want to tip your miner more, the transaction is more likely to go through quicker. Okay, now these rewards pay for energy bills to uphold the network. Okay, very, very simple stuff. So then, in terms of computational power, there are things or groups called mining pools. Now, mining Bitcoin in 2009 was relatively easy, and Satoshi themselves actually mined it on his or hers home computer, like a laptop, for example. Okay, it was relatively easy, didn't require a lot of RAM to actually find the solutions. Okay, and they accumulated around 1 million Bitcoin just from personal devices. Okay, so now Bitcoin miners use ASIC rigs, which are purpose-built mining rigs. Very, very expensive, okay? And you probably need a couple of those as well to compete with the miners mining Bitcoin today. So what a mining pool allows you to do is actually join or pool together with multiple other people and use your computational power and connect your computational power, okay, to compete with these miners who are using specialized equipment. Now, essentially, when you get lucky enough to add a block to the blockchain of Bitcoin, the bit reward is actually split between all of the miners within the pool. okay? So it's essentially you all contribute, you all compete, and you all get rewarded. So then, in terms of the halving event, now it's very important to understand how this links in with the block difficulty and the block time, the average time it takes to publish a block to the chain. So it takes around 10 minutes, okay, as we mentioned before. Bitcoin has protocol which halves the Bitcoin reward, BTC being the ticker symbol for Bitcoin, okay, in case you see that on the slides. It halves the reward for each block mined every 210,000 blocks, or on average every 4 years. Now, because this reduces the supply of Bitcoin into the circulation, often, okay, on average, if history repeats itself, around 12 to 18 months after this event, the price of Bitcoin reaches new record all-time highs. It spikes, okay? And this is the cycle of Bitcoin, the 4-year cycle, okay? Very, very important in terms of investing to know where you are on this cycle. So then, a graph of the halving event. We can see from the Genesis block, which was the first block on the chain, 2009, we can see the Bitcoin reward of 50 Bitcoin every 10 minutes. And if Satoshi were to be doing this, okay, you can see how rapidly they would accumulate 1 million Bitcoin over a few years. So the first halving went down to 25 Bitcoin in November 2012. The second was July 8th, 2016. Okay, and around a year later, 2017, 2018, we can see the spike in price there. The same with the first halving event. Okay, and we're now moving into the third halving event, 2021. We're around the time where Bitcoin's price over the next 6 months should peak. We will see how that plays out, however. So then, some limitations of blockchain for the Bitcoin network. We have mining is energy intensive. Okay, it's incredibly energy intensive. It's a costly operation to run these energy intensive mining farms. Processing microtransactions is not very scalable for Bitcoin, as again, the transactions are added every 10 minutes. It's relatively large transactions which are made with Bitcoin. And transactions are limited by TPS, transactions per second, because of this block time and also the block size, okay? So then in terms of combating some of this TPS, transactions per second, there was an improvement to Bitcoin made called the segregated witness, or the Segwit. Okay, so the blocks in the chain, I'll just read the slide quickly. Blocks in the chain have a maximum data capacity of 1 megabyte. And so a Segwit separates the signature data, which is around 65%, a massive percentage of the transaction, away from the block, freeing up space for more transactions. Now, essentially, the signature is the wallet balance verification, so it's very important to have this. Okay, so the signature is then attached to a different part of the transaction, freeing up data within the blockchain. So progress has been made. We can now save up to 65% of the capacity of each block. Okay, so allowing 65% more transactions to actually be processed on the blockchain network as a result of this limitation which we're facing. Now, it's still kind of an issue for scaling. However, I have no doubt that improvements will be made again in the future. So even though Bitcoin is incredibly energy intensive, we can see here that we really have nothing to worry about in terms of, especially in terms of cost, okay? So Bitcoin mining, we can see in comparison to gold, very little in comparison to the banking industry is a fraction, okay? Now, in terms of people trying to say that Bitcoin is incredibly harmful for the environment, etc., etc., the current banking system outweighs it heavily, okay? So in my opinion, that argument is almost obsolete at this point, especially as we are getting more green mining farms popping up all around the world. So then, that is the Bitcoin mining module complete for the course. It was a little bit of a whistle-stop tour. However, hopefully we're beginning to understand the fundamentals of how the mining operation works for Bitcoin, how the blockchain is secured with those hash values. Again, without getting too into detail. Okay, this isn't an advanced course, I must remind you. In terms of the actual operation that goes on behind the scenes, it's the same thing as asking someone to explain how the bank verifies transactions, okay? We don't necessarily, or the majority of us may not know how banks verify our payments and make sure they're true. However, we trust it. We know it works. We know it's necessarily secure, okay? We've been trusting the banks for however long at this point, and we still, a large majority of us, couldn't explain the actual ins and outs operations of a bank. And so if we don't necessarily understand the absolute operation behind Bitcoin, okay, every single detail, it's not necessarily a problem if we are long-term investors or just simply believers in the technology. Okay, we don't have to become experts. We just need to know loosely what happens, how it happens to some degree. And also, we need to understand how to, essentially, when we're faced with questions about Bitcoin by friends or family, for example, we want to be able to explain how this thing works. So that's the main priority, okay? Now, hopefully you've enjoyed this module. Again, it was very complex in terms of difficulty for this course in particular. However, hopefully, if you were to go through this module again, things will start to click, if not the first time. So then that is the module complete, and I will see you in the next module.